Welcome, everybody. All right, I got another weekly update for you about the S&P 500 and TSP and all that kind of stuff. Just give you a forewarning, I did make some changes to the calculation process I use for my price targets. I'm reverting back to my original process or calculation method that I used to use a while back. So we'll get basically what happened is I found out that the method I was starting that I've been using for a little while here was putting a little bit too much influence, or actually way too much influence on Alphabet or Google, GOOG and GOOGL, their earnings, having too much influence on the entire index. So I've decided I'm going to go ahead and revert back to my original format, but with an adjustment, some of which you'll see, some of which will look different to you when it comes to when we get to the slides. But basically, without going into long detail on that, just some of these numbers are not going to look quite the same as what you saw more recently, or what, as of right now, was still in the announcement post. I will be updating that. So just say forewarned here. Okay, so we'll give you an update on what's going on with earnings across the index this quarter, what's been going on and whatnot. So, and that's what this will be about. Okay. Okay, as of this recording, these numbers are going to be a little bit different from what you'll see in the announcement post at the moment. Right now, I think in the announcement post, I have my swing out target, which at 43.05. Now, for the swing out target, that's not really such a concern for those of you guys who are the buy and hold crowd, but it is intended to give you an idea what the index might top out at in the near term before until we get more earnings data to come in and push that up higher. For those of you guys doing the swing trader group, though, obviously most of you guys will know what that is all about. Not going to really discuss it much here. I want to try to keep this kind of quick and short and to the point. But all right, so the total trailing 12-month and next 12-month earnings data. This is just raw looking at all the EPS for every company in the index without any kind of bias at all in any direction, which is how I used to do things. And it worked great for quite a while until some constituent changes started happening, and then I think when the market started to get a little bit more irrational in both directions as well over a 2 or 3 year period. But by and large, though, it was a wonderful, very accurate method that I used to use. But then when some constituent changes came around, yeah, I'd have to make little micro adjustments here and there because of the way the earnings per share, like of the company that's leaving the index versus the one coming in or something, or if a company did a stock split or something. It tended to affect all of my numbers here. So for that reason, this is going to look a little bit different for you now than what I've shown in the past. So just don't let it bother you too much. What we're more concerned with here is what's this growth percent right here. That's what we want to know. That's plus 20.09%, which is actually a very healthy growth across the board. This is one of those, another reason why I say try to stay in the stock funds as much as you can, because you don't want to be missing that kind of price growth. And for those of you guys who are swing traders, growth like that is not very hospitable at all for swing trading between the stock and bond funds. Better to just stay in the stock funds, and then if anything, if you want to swing, be a little active. Maybe do like what I'm doing, which is bounce back and forth between 100% C fund and 100% S fund, or something along that line, where you just stay in stocks the whole time. Save the swing trading between stocks and bonds for when growth is slower, like maybe single digits or even flat or negative. Anyway, for those of you guys who are buying holders, that's especially what this is about. But it's for everybody, swing traders, buying holders, whatever. So as of right now, with the adjustments I've made, with my calculations, I put the value of the index right now with no earnings growth at all factored in at 38.45. Future value, which is basically what I expect this current value to reach a year from now, that should climb up to 46.20 based on the forward earnings estimates that I currently have. And that puts, and then for the actual price of the S&P 500, based on that information, if that growth trajectory stays the same, I wouldn't really expect it will, but it could. But 5085, basically somewhere in that 5075 to 5100 level a year from now is actually possible. I wouldn't necessarily bet on it actually happening because, like I say, this growth rate might slow down some. But that's just kind of projection based on what the current growth trajectory is. As it slows, you'll see this one also come down. All right, so the swing out target. Now, I've been noticing, the stock funds, CNS funds, or actually the S&P 500, which is what the C fund follows, has been a little bit sideways lately, which is kind of an indication that investors don't really think that price needs to go up any higher until we start getting more earnings data to kind of help justify it. So I've made some adjustments there to kind of bring the swing out target back down to at least pretty close to what the current price was, or at least what it was actually able to reach on Friday before it closed a little bit lower. But so 42.35 is right now what I would project as the swing out target until we get some more earnings data in, and we have a very busy week this coming week, and we'll see. I'll show you that when we get to that particular slide. Okay, so 40.85 to 42.35 is what I would consider a normal, reasonable trading range from top to bottom. If it gets down below that point, that's when I would start saying we're starting to get down a little bit more on the irrationally pessimistic side. Okay, also I have combined my my beer or bond equity earnings ratio. Put it over here on this same slide instead of on its own. And right now it's still pointing at 90% stocks and 10% bonds. For those of you guys who are a little bit more averse to risk and want to have as much you can in stocks, but are a little bit more paranoid or whatever about maybe a recession or a drop or something, just keep your eyes on this. I do have recommendation in the main announcement post, hashtag main announcement, that you can also follow and watch for changes to. This does adjust in the direction of bonds as stock earnings yield. This 20%, if this starts to come down more toward 10 or even 5 or whatever, the beer is actually going to start biasing more toward bonds. It'll still be more toward stocks, but most likely it might go down to like 80% stocks or even 75 or something. And then as bond yields, particularly the 10-year Treasury note, which we'll talk about later here, that'll bring up that'll bias it also toward bonds more. That always happens. Again, we'll talk some more detail on that, or you can, or better yet, watch some of my other videos. I want to try to keep these reasonably short, and I don't want to have to keep rehashing the same information and making these videos needlessly long. All right, so let's move on. Oh, actually, the trailing. The price to earnings ratios here, trailing and forward PEs, basically, this is getting kind of on the elevated side, but when you have this this kind of price growth, elevated PEs like this is actually to be kind of expected, to be honest with you. I wouldn't be too extremely concerned about this. So this could be a good reason why you might hear people on the news, which I don't even really follow much, talking about how frothy stock prices are. I know Jerome Powell actually said something about frothy stock prices the other day after their rate policy announcement. But generally, when you have strong earnings growth like this, it kind of helps. It justifies a little bit the higher PE ratios. And then when earnings start to flatten out, then expect these to come back down a little bit more to maybe more to the 20 or so range. All right, moving on here. Okay, this is the same. This is the earnings data it's projecting out. So as you see here, I had 31.52.66. I need to make a slight adjustment to something here, but that's beside the point. This is basically that same number rounded up. And then looking forward to the next 4 quarters, I'm expecting that number over the next quarter, see to jump of actually 41% year over year next quarter, or up from 31.53 to 34.05, and then 6 months from now should be up to 35.95, and then it'll climb up into the 3700s over the third and fourth quarters out. And also, you do see that the quarter percent, this is basically year over year performance here. It's getting higher and higher standards to compete against. So because of that, you're going to see that it's starting to taper off. See, it's going to be at its peak here within the next quarter, and then it'll start to taper off down to 5%, which is a little bit more on the normal side. And that's you can still get a good 20% earnings growth per year, even with 5% quarterly. All right, so then looking at the 12-month numbers, which is 4 quarters combined. This is just another projection of what it's looking like. So it will be slowing down over the next 4 quarters. So just don't be. It is to be expected that the price growth will also slow. Doesn't mean it's going to completely flatten and go negative necessarily. It means it'll just grow at a slower pace. Okay, so for those of you guys who invest outside TSP, whether in IRA accounts or regular taxable brokerage accounts or whatever, that's again, I put this information up for you guys so you have an idea where you might want to focus your attention if you have money that you want to invest and you're not really sure what to do with it. So right now, this is still projecting the energy sector to be the top performer. As you see here, energy as a whole is showing negative trailing 12-month earnings combined, but over the next 12 months, they're expected to report positive. So that's where all that strong growth is. Once, these negative numbers always tend to really skew the expected percentage. So I'm going to watch out for this kind of stuff. But rightfully so, it is up here, up at or near the top. Okay, consumer discretionary, I've talked about before. You want to see this at or near the top as well. That's always a good sign of a healthy economy. And when you got 45% expected growth from that sector over the next year, that's really good and strong. Okay, real estate. I can't really give you good information on that, unfortunately. The REITs, real estate investment trust companies, unfortunately, the way Ameritrade's doing things now, which is how I get my data from. Now, let me first explain that real estate companies usually report their earnings by what's called funds from operations, or FFO. Problem is, when they report FFO, it's not really compatible. It's perfectly compatible with earnings per share that all the other companies report. So it's basically like putting an orange in with a whole bunch of apples, and I need an apple. So what I need is EPS data. So what tended to happen in the past was I would get actually converted EPS data through Ameritrade through its source, and that way I'd have something I could cross compare that's the same, like an apple versus an apple instead of an apple versus an orange. Problem now, though, is I think maybe because the Schwab takeover, or with whatever the source, they're no longer doing good regular earnings updates for a lot of the REITs anymore. So I have to use alternate sources to get their information sometimes, and where I get those reports from don't tend to give me any forward estimates. So I don't have a good way to project what's going on with the real estate sector, unfortunately. But they do tend to be good. If you do want to learn anything more about real estate sector, if they're worth investing in, I recommend you talk to Scotty Cox. He's a longtime member of our group. He knows a lot about investing, and he knows a pretty fair amount about the real estate market there too. All right, so looking over at the industrials specific sector, because particularly transportation is what I have an interest in. As you see here, it's currently negative earnings, and it's all airlines, as you see here. Airlines are just massively negative, all because of the COVID effects, and they're still going to be negative over the next 12 months, but they're not going to be so badly negative that they're making the entire that they're uh, completely counteracting everything that the air freight and logistics and the road and rail groups can make up for. So that's a positive. As you see here again, it's a negative 84%, but again, negative 1392 is actually better than negative 8782. So this should be a positive number. It's just the way all my formulas work here is just sometimes I have to deal with this. Okay, road and rail though is expecting 26% growth. That's another strong one again. Road and rail, as I mentioned before, is always a good bellwether for the broader economy as well. You see what's going on with that. You can see you have a kind of a decent idea what to expect from the rest of the economy to go with it. All right, so quarter to date so far, we have 278 companies that have reported earnings updates this quarter. Very strong earnings so far here, almost 50% growth. Stronger than anything I've seen since I've been recording this data. But again, we had a bear market and kind of a mini recession, I guess. It was a recession. It wasn't huge, but it had a very overreactive bear market, and the economy's been stimulated a lot as well. So again, this is I shouldn't be too surprised by this because I have seen high 30s, even low 40s growth rates from the stock indexes as well in some years. Okay, so out of 278, that's a little bit more than half the index, 55%. 215 have reported positive performance. 3 are neutral-ish, and 60 are negative. 77.3% are positive. That's about in line with 2018 quarter one here. You see a lot of very strong performance here. A lot of double-digit performance. So this is all positive again. Good news there. All right, so looking in the coming 5 weeks, this week here is we've already hit the climax as far as how many companies reporting in the same week is concerned. That was just this last week. But this coming week, May 3 through May 7, is still going to be a busy week. And I still have a couple of weekenders here I got to push into one side or into some direction. Again, as I mentioned before, some of these companies will report earnings this week. Some might push back to next week or some other later time. But by and large, most of these 123 probably will update earnings this week sometime. Next week, it'll slow down to 33, which is quite a bit slower as you see here. Most of that will be tentatively on Monday, May 10th. And then after that, it'll be down around 2 dozen-ish, or a little bit more than a dozen until it tapers off to single digits in June. All right, looking at bond rates now. I know this is all noisy every time we look at it, but just kind of want to give you an idea, a general idea what's going on here. Short-term bond yields have been still hovering way down at 0.01, or basically what we call this 1 or 2 basis points. For those of you guys who might not be familiar with the terminology, 0.01% would be 1 basis point. So one, it was around 1. Short-term yield stayed around 1 or 2 basis points all week. The longer-term yields that affect the G fund, the G fund's growth rate, as you see here, they went up, they climbed a little bit. They were up, 1.58% on the 10-year yield last week. It's climbed back up to 165, but it looks like it's somewhat stable. We'll just keep our eyes on it. Again, these are more of the indication of inflation, and these are more of an indication of what the bond market expects the the Fed will do with the interest rate policy. We know that the Fed has already said they're not going to raise rates most likely in anytime in 2021. Maybe in 2022 they might. So I would expect that these short-term yields will stay on the very low side for an extended period of time. Now, inverted yields is what I'm watching for here. This 2-year versus 10, 2-year versus 5, and 3-year versus 5, for example. When they start to invert, when they actually do invert, that's usually an indication that within the next 9 to 24 months, a recession could come. Doesn't mean one will, but it means one could. And that's, so that'll give us an early warning of when recession could justifiably come. But, and not in the near term, but like, as I mentioned, 9 to 24 months out, more than likely is when that would happen after we first see an inversion. See, we're nowhere near that point right now, so this is really nothing to be at all concerned with as far as these rates are concerned. Okay, continuing on with the bond yields, this is the 10-year Treasury note, what it's been doing. Remember when stock prices were kind of going a little bit haywire recently? These are trend lines I drew before. Based on that, how the trajectory was going steeper and steeper on the yield, the yield growth. But as you saw here, it topped out at 1765, or basically 1.765%. It came back down, found some bottom here in the mid 1.5 range, but has since come back up here to the 1.6 range. Looks like it's sitting. Looks like it might stabilize there again. There's also a pivot here if you're into the technical stuff here. You see here it pivoted in like about a week or so to right here with all these different prices. We're in the same yield area as what we have now, and also a little bit of a another pivot right here. Okay, so what we have here overall is bond yields look reasonably stable now. Maybe a chance it could drop some more, but we'll see. All right, and looking at the short-term versus long-term bond yield curve, again to give you a visual of the for inversions, which basically an inversion, like I was talking about in the previous slides, is when the short-term bonds here get higher yields than the long-term bonds, and so you'll see the chart go from here down and then back up more often. The medium term bonds tend to not be so reactive to anything like they react, but they're not as sensitive to Fed rate hikes or inflation or whatever as the shorter and long term bonds are. So we tend to see some kind of inversion. I will show you on a future, or just look for previous. Actually, just look for a previous post by me in the main group about bond yield curve, and you'll see some information on that. All right, looking at TSP prices. This is what we have currently for down here at the bottom, April 30th, and all right, they're kind of an up and down, or a little bit more down week, at least for S Fund. More down also for C Fund as well. F Fund was up and down a little bit here, and then I Fund actually, it was kind of a little bit of both, but more down. Now, looking here though at the monthly, we can see that S was more strongly green, coming, or actually, no, 23rd would have been right here where this 5.29% C Fund is. So the first half of the week, S Fund came on strong, started outperforming C for at least that part of the week, but then the last 2 days, C Fund outperformed on Thursday and Friday. Now, over the year, though, S Fund is still outperforming C by about 0.5%. It did get up to about almost, it looks like about a 2.5% or so lead right here over the year before it slowed back down. I can't really give you enough insight into the rhyme and reason for that. S Fund does tend to outperform when inflation is stronger, so the fact that it's starting to it seems like it's not performing as well as C fund lately. It could be an indication that the inflation, it actually is that the inflation that we're expecting truly is a little bit more transitive in nature, and that it could be slowing down as well. Okay, for those of you guys in the swing trader group, you guys who follow me and want to know how I'm doing, how the C and S funds are doing compared to each other since the date of my last IFT, which was 5 March. Now, when I reset this baseline, as we talked about before, S funds started out on top right away, but then came back down. Again, I wanted to move my money from there, from S to C back over here, but too early in the month in my second IFT, I didn't really want to make that move. So I got stuck there. So right now it's, as you see here, it's more indication that C fund is outperforming S, at least since, looks like March 15 or so. Now, there are a couple of spots here where S came back up, like right here, 29 March, and then again on 20 April. But since then, it has slowed back down again, so might hopefully see it flatten out again and take back off again. Who knows? No way to know for sure, but it just either of these funds will do you good. Yeah, as far as you're getting good performance. Yeah, any combination, 100% C, 100% S, any combination thereof. Just stay in these funds, you'll do just fine. Okay, I want to go back to the TSP prices as well, with because I forgot to mention iFund. Because there has been more, some talk in the last month or two about, what about iFund? Because it seems like it's doing okay. Yeah, well, it was only 1%. Let's see, 1.5% lower than C Fund on 16 March. But then if you accelerate over here or advance to today's date or April 30, I mean the last date I have share prices for, it's now actually 5% lower than C Fund. So again, this is another reason why iFund not such a great one to be in. 6.73%, not even halfway through the year, is actually not too bad. But compared to these two, you might see why we still favor CNS funds. Okay, so that's going to wrap up this week's presentation. I'll have more information for you guys a week from now, hopefully, with some more data for those 120 plus companies. Add in their part of the pot. And with that 120, that'll put us right around 400 or just under 400 companies in the index, which is about 80% of the index. We'll be somewhere near that, 75-80% reported by this time next week. All right, so that's all I have. And if you guys have any questions, don't hesitate to ask them, or watch some of the previous presentations, or search the group for some of these topics that you heard me talking about. You might learn some stuff from that as well, because there's plenty of good information already in the group too. But don't be afraid to ask questions, and we'll help you out. Okay, thanks again. Have a great weekend. We'll see you guys next week.